Thanks for the honor of, got it. Thanks for the honor of speaking today. I am going to leave my card on the screen just for a little bit because my phone number is there and my email and website. I'd like everyone to be prepared to take notes. I go a little fast. I'm going to try and slow it down, but sometimes I speak a little too fast. If you're interested in a topic, jot your question down at the end. Todd will be entertaining questions. You can chat them in and probably not worry about it. And Todd will ask it at the end of my 40 or 45-minute speak today. And if we don't get to it, well, then you can always call me. Okay, 732-329-8900. Okay, so let's get going. Here are the areas we're going to be discussing today. We're going to be talking about audits, IRS audits. We're going to be talking about the deductions, if not listed properly, will raise a red flag, just like on your little mailbox. IRS says, okay, that looks like a red flag. We're going to audit you. And I'll give you some examples of what the type of deductions would raise the eyebrow of an IRS computer that is going to flag your tax return for an audit. So with that, let me start out with two jokes. Okay, jokes, let's put them in quotes. Not sure they're funny. They're dad jokes, all right, at best. But here goes. Why did Sherlock Holmes get audited? All right, Marty probably already knows this one. I don't know, but he had too many deductions. Okay, Groner, thank you very much. Second one is, why was the seafood restaurant being audited by the IRS? Well, they thought it was a shell company in a fishy business. So yes, another groaner, but two pertinent somewhat jokes because, thank you, Jacqueline, for laughing. So the two pertinent jokes because they deal, of course, with audits and deductions. And that's what we're going to be talking about today. So let's get to it. Our first topic is going to be discussing what an audit is, okay? Death, taxes, we all know you can't avoid them. I really can't speak authoritatively on death, but I can on taxes. Why is that? Well, I've been doing, well, actually on October 2nd, I celebrated my 35th year of preparing tax returns as a CPA. It's 35 years of doing tax returns. I built my practice up to preparing over 600 tax returns a year. And so I've seen my share of what we're going to be calling audits. Okay, I've seen, and mostly all the time, I see these audits from new clients' tax returns. Okay, the prior accountant either wasn't aware that he was raising red flags, or she just didn't report something appropriately. But the client comes in with, oh, I got a letter I got audited from the IRS, and my prior accountant didn't know what the heck he was doing. And so they give me the tax return and the notice, and well, we make everything all better. But a lot of times it's not the accountant's fault, and we're going to find out why. There's two types of audits. One is a field audit. You don't want a field audit. Okay, a field audit is when the IRS revenue officer comes to your business. Now, they won't knock on your door. They used to. One of my first clients in Manville, it was a graphic designer. He called me. I was in Florida on vacation. He called me and said, Mark, someone is knocking on my door. They say they're from the IRS. Should I let them in? I was on vacation and I said, you can't not let them in. It seems like you're being audited. And the guy just came in, gave a card saying we're auditing you, have your accountant call me. But nowadays, no, they don't knock on doors. You're going to get correspondence in the mail saying that we're auditing your business. And here's the things that we're going to need. They won't come to your house. Never seen that. The field audits are not for individuals, they're for businesses. So that's the first type of audit. Okay, the second type of audit are correspondence audits. There's a field audit and there's a correspondence audit. And there's two types of correspondence audits. One is very simple. You're not being audited, but people call it an audit because you got a letter from the IRS. It must be an audit. No, it's a CP2000 series in the upper right-hand corner of the notice. If you get one of those letters, you just didn't report everything the IRS was expecting you to report on your tax return. For instance, a W-2 from a job you had for 1 week in the prior year and you forgot to give it to your tax preparer. Well, IRS doesn't forget because all the W-2s are uploaded. It has your social security number on it. They were expecting you to report whatever was on that W-2. Well, that's the CP2000 letter when information doesn't get matched. It's a mismatch from the IRS computer to your tax return. You get a letter saying you didn't report this. One of two things: either pay the additional tax we're calculating on this, or send us an amended return explaining why this item doesn't belong in your tax return. Okay, so that's a correspondence audit. That is the CP2000 series. We're going to talk today about the other kind of correspondence audit. It's a letter that the IRS sends to individuals or businesses asking for clarification of an item on your tax return. It could be an income, a deduction, a loss, a credit, some indication on the return prompted the IRS to say, okay, we need more information, or what we're seeing doesn't look like it's legitimate. It may be fishy. We want you to explain it, please. So that's the correspondence audit we're going to be talking about today. And those items that the IRS sees on the tax return, we're going to call them red flags, just like the mailbox. Goes up, goes down. Red flag is something we want to avoid. Okay, so home office deductions is the first item I'm going to talk about. The 2017 Tax Cuts and Jobs Act did away with home office deductions basically because you couldn't itemize it on your itemized deduction list. You worked for a big firm that gave you a W-2 and they wanted you to have a home office, but you used to be able to deduct the costs of that office. Now you can't. Who can deduct it? If you are a sole proprietor or you formed an LLC for your business, you are reporting your income and deductions on a Schedule C. Those are the people that can report the home office deduction. Also, partners in a partnership can report home office deductions. S corporations and C corporation businesses don't get this deduction on a personal return. They need to reimburse those employees they're asking to have a home office. So with all what's going on the last 2 years with the pandemic and everybody telecommuting from home and they have their office set up, they're all complaining they can't take the deduction. And so my advice has always been, ask your employer to reimburse you for the expenses associated with your home office. That won't be taxable income to you. It's a reimbursement of an expense. The business, therefore, can take that deduction, not you. Okay, so the home office deduction, where's the red flag associated with that? Well, it used to be, prior to the 2017 Tax Cuts and Jobs Act, it used to be the actual deduction itself was the red flag. IRS didn't like employees working in an office to be told that they have to work at home by the employer and take a tax deduction for it. IRS didn't like that. So they kind of audited those tax returns that had that deduction. It was a red flag. Nowadays, it's not. A couple of years before, now it's not a red flag. The way you present the deduction could be a red flag. For instance, I have a client that tried to convince me, and they put forth a very good argument, but they tried to convince me that their apartment that they're renting, a one-bedroom apartment, he was single, he was actually his office also. So he lived and worked at the same place. And he wanted to take a 50% deduction of his living space as a home office deduction. So the way the home office deduction works, you take your square footage of, I'm trying to make an L7. Yeah, right. Okay. You take your square footage of your office, say it's 10 by 10, 100 square feet, and say you have a 2,000 square foot house. Okay. That's 5% of the house is the office. Well, you can take 5% of real estate taxes, mortgage interest, insurance, repairs and maintenance, utilities. 5% of all those expenses can be your home office deduction. Can you imagine if the deduction was, if they all added up to say $20,000 easily in New Jersey, right? Property taxes alone are 10,000 plus. Mortgage interest, yeah, 10,000 for a year is not a lot. So if it was $20,000, he wanted to take a $10,000 deduction for a home office. I've done a lot of tax returns. That's excessive. 50% is not something the IRS is going to say, oh yeah, sure, no problem. Red flag. Also, I've seen people try to put down for repairs and maintenance, say 5% of whatever repairs were for the house, you would take. So if someone mows your lawn, for instance, maintenance on the house, you can take 5% of that as part of your home office deduction. After all, your customers coming up to your house want it to look nice, right? Well, he renovated part of his house, and this client had $25,000 worth of renovation costs, and he wanted to take the percentage of those as well. But no, those are capital improvements that have to be depreciated over time. And well, if the IRS saw a $25,000 repair on the form, which is a form 8829, they get to see these things. Well, that would be a red flag. So what happens when the red flags go up? Well, you get a letter from the IRS. Okay, I won't keep you in suspense anymore. What are your chances of getting a correspondence letter because of red flags on your tax return? If there weren't any red flags, IRS randomly audits people, your chance would be less than 1%. 1 out of 100 people have the IRS computer select their tax return for audit. They send a letter out saying you're being audited. Now, is it the W-2 employee that just has interest, dividend, and a standard deduction? No, it's not going to be them. It's going to be the people that are self-employed, that have other businesses, that have K-1s, that have someone that has a rental property, something that is more than just a basic tax return, is what we define it as. So those people have a 1% random selection. We call it the audit lottery. Why do we call it that? Because some clients come in and say, I want to take that 50% home office deduction or for the area of the office. And I say, okay, it's your tax return. I'll prepare it based on the facts you give me, but are you sure you want to play the audit lottery? Because obviously he's probably going to get audited, but there's no problem in playing the audit lottery if you can substantiate your position and be able to explain to the IRS satisfaction the deduction that you're taking. There's nothing wrong with that. People should be aware that they may be asked to prove their deduction. Okay, so being audited in and of itself, not a problem. But I've seen so many clients, when they get the letter, the fear factor just, oh my God, they're auditing me. I'm in big trouble. I'm going to jail. Now, well, maybe they're going to jail, but here's a third joke. I promise you, it's not really a joke, but it's the last one. I had to look these up. A professor was teaching taxation, and after his lecture about tax avoidance and tax evasion, he went into so much detail, and he asked his prize student, can you explain to me what I just said to you succinctly? What's the difference between tax avoidance and tax evasion? The student just said one word: jail. Because we can avoid paying taxes with all the tax code, the rules and regulations at our disposal. We can take advantage of all of them and avoid paying maybe all our taxes. But to evade taxes is to not follow the rules and regulations. And that's an area where the IRS can pursue legal remedies, ultimately putting you in jail. Do they want you in jail? No, you can't pay your taxes if you're in jail. They'd much prefer work it out and negotiate a settlement. So no, you're not going to jail if you get one of these correspondence letters, not if you didn't evade taxes. So you're just going to have to come up with an explanation and work with your tax preparer. We do this all the time. Work with your tax preparer, give them the information that they need in order to respond to the audit. So let's talk about another area where I've seen, this really bothers me, this one. Suspiciously rounded numbers. Not sure anyone in the audience does this, but I've seen it. And there's one client in particular every year, they give me suspiciously, I call them suspicious. They're just lazy, sloppy. They don't go through the details of their receipts on their bank statements, credit card statements, wherever they're getting their information from. They give me for their business deductions, rent, $24,000. Utilities, well, $100 a month, $1,200. Telephone, well, that's about $400. Okay, $4,800 a year. It's like, we know you're just guessing at these numbers. You're not even making believe you're looking at documents to give me these numbers. They're just coming from your head. Now, you can do that. We are allowed to present tax returns to the IRS that are estimates of what we will have as deductions or income. We can present them as estimates, but we're expected to label them as estimates and follow up with a tax return that has actual. Okay, there's nothing wrong with presenting a return, but if every number on a deduction list is rounded to the 100 or 1,000, it just seems that it seems like a red flag to me. So be careful when you give your accountant numbers. I tell my clients, I will put whatever number you give me on your tax return. It's your return. You're signing it. Okay. And my support is the numbers you're giving me. Your support should be bank statements and credit card statements and cash receipts to support the numbers you're giving me. Will they all add up to an even $1,000? I don't think so. So what happens if you can't actually respond to an IRS correspondence letter appropriately? Like, I don't know how I got that number. It was an estimate. Well, if you can't prove any of it, they're just going to deny the deduction. That's it. They're going to deny it, and you're going to have to pay more tax, plus penalties and interest. You're not going to jail. So be wary when you give your tax preparer or you put your own numbers on a tax return. Just be careful. All right, let's talk about an area where, so we talked about home office deductions. Watch out the square footage, red flag. Watch out the maybe repairs and maintenance, too high, red flag. Let's talk suspicious numbers, red flag. Okay, let's talk about claiming higher than average itemized deductions. Okay. Not much you can do about claiming your mortgage interest. Not much you can do about claiming your property taxes. Almost nobody makes those numbers up because you have this form 1098 from the mortgage company that tells you exactly what those numbers are. It's a piece of paper, you give it to the accountant, he takes those numbers. It's the areas on the itemized deduction list, medical at the top and charity, little halfway down. There's other things on the form, but those are the two main areas that people have large numbers or could have large numbers. So what does the IRS do with your information? They compare it to averages that they've accumulated data on. It's called, if you want to Google it, I'm going to give you some stats, a stat. From the source is the IRS Winter 2019. This is the only one I could find. They're basically 3 years behind in getting this data together. It's called the Statistics of Income Bulletin, SOI. They abbreviate it. Of course, there's an acronym for everything. So this Winter 2019 SOI, IRS has this data. And they see that, for instance, $200,000 to $250,000 of adjusted gross income. If you have that much income in that range, they expect to see $5,638 worth of charitable contributions. Now, there is a different number for every income range. You can look them up. I don't want to bore you with it, but the IRS has this data. And if you put down 15,000 in that income range, they may say it exceeds our average. Should we audit him or not? I don't know. This artificial intelligence computer program may say, yes, you get a letter. Prove me your deductions, please. More often than not, in New Jersey and in my practice, in that income range, I see actually deducting less for charity. It is what it is. They're giving me the numbers. So just saying the IRS has an average, and they're comparing it to what you're reporting on, they may. So I have a client, had him for like 30 years. Such a great guy. He's a minister. And Tony, if you're out there listening to this, I love you, man. The first year that he was the minister in this church, he was coming off of a W-2 job. And I think he had a big pension or something that he didn't really need the money the first year working for the church, but the church gave him a salary. I think it was 50,000, somewhere around there. And he donated it back. So he took a $50,000 deduction. He was questioning this all the way. It's like, can I really do this? Is it? And I said, Tony, you gave him the money back. We got to take the deduction. You're probably going to get a letter. Red flag. It's like, He donated 100% of his income. Of course, they're going to audit you. It's not really an audit. It's just a correspondence letter asking for more information to explain the deduction, which we did. We gave him a copy of the front and back of the check and the ID number of the 501c3 or church organization. And the IRS said, okay, couldn't deduct it all, but we carried it forward until we could. So yes, charitable contributions, medical expenses for that income range, by the way, $17,400. That must have health insurance in it, or America's pretty sick, because 17,000 is a lot of money to have a deduction for in that income range, but that's the IRS average. So if you go above it, you may be red flag. You may be taunting the IRS to give you a correspondence letter. Okay, we're going to talk about another. So we talked about what? Home office. We talked about suspicious numbers. We talked about charity and medical being too big, too high. Let's talk about auto expenses and meal expenses. Every business basically has these. And you could raise a red flag, for instance, if you deduct 100% of your auto mileage. The IRS allows us to take a standard deduction for each business mile we travel. So 68 cents per mile. You travel 20,000 miles, you get 68 cents for every mile as a deduction, which is great. But that begs the question, what car did you use to go to the supermarket, to go to Aunt Mabel's birthday party? How do you use a car 100% of the time for business and do everything personal in your life? IRS will probably say, you can't, you don't, you won't, you didn't. Red flag, you get a letter. It's not as simple as that because, well, in marriages, you have another car, probably, and you could say, well, we use my wife's car for everything else, or my husband's car, or you work for a business and the business allows you to use the car for personal purposes. There's actually something that goes on the W-2 if you do that for a business. They're supposed to have you claim additional income for the personal miles that you travel with a business car. Not many accountants actually do. I don't do that. And not many accountants actually go through all that paperwork to. It's such a small deduction. We just don't do. That's the one thing we leave for the IRS auditor to find in an audit. Let them have that. Okay, because they have to substantiate their claim somehow. So 100%, you got to watch out. 95, right? Still a big deduction, and you're allowing leeway, right? Okay. And the other thing, for if you're not a business claiming the deduction, if you're personally like an LLC or a sole proprietor, if you're claiming this auto deduction, you want to make sure if you get that letter, you can prove your mileage deduction. So you got the red flag, you got the letter. What do you show the IRS auditor? What they want to see is a log of the miles that you've traveled. Who does that? Well, they have these apps now. I'm 66. I don't know how to use that app. But all the millennials know how to use that app. So just you plug in the information in the app, and then you do a printout at the end of the year. They want where you went to on the business trip, how many miles you traveled, and what was your business purpose. They want that. So what I use is my Google Calendar. I put down every time I have to go somewhere. At the end of the year, I use Google Maps and I figure out the miles and I back into a log. So I don't have to constantly every time just do something about it. I just wait to the end of the year, and that's my December thing to do. I have nothing else to do. Tax returns are all done. October 17th is gone. Now we have the fiscal years and IRS notices to respond to. So watch out on your car mileage. You want to substantiate that. And let's talk about meals. It used to be meals and entertainment was 50% deductible. I'm about to tell you a red flag that my guess is 60 to 70% of the tax returns that you have someone prepared for you, not mine, have the phrase meals and entertainment as the deduction. It's probably just the dollars for the meals, because the accountants know entertainment is no longer deductible since 2018, maybe 19, not sure on that. But the computer software every year carries forward our descriptions. Your descriptions, if you're using TurboTax, it probably carries it forward. So from the time in the past when meals and entertainment was a 50% tax deduction, that phrase is still there, meals and entertainment. And you're just popping in numbers, not thinking that entertainment is no longer deductible. So I challenge you, go look at your tax returns for the last 2 years. See who has meals and entertainment. And if a tax preparer gives you in the future a tax return that says meals and entertainment on it, give it back to him and make him change it. Because why? Entertainment's no longer deductible. Red flag. What? How simple can that be? IRS is seeing entertainment on the tax return as a deduction. It's not a deduction. Please explain why you did this. And you're going to have to say, well, the dollars are actually meals, and here's my substantiation for all my meals. What a headache. You don't want that. So watch out for meals and entertainment. And by the way, in 2021, they changed the law temporarily so that business meals are 100% deductible. I guarantee you there's tax returns out there amongst you that they only deducted 50% meals and meals as a deduction, because that's what we've always done. If you're not on top of the tax law, these simple little things can lose you money. And so please be aware that for 2021 and 2022 only, business meals are 100% deductible. Okay, let's talk about business losses. It happens. In the pandemic, people lost money. Prior to that, if you're just starting out, small businesses, you lose money. I want a tax deduction. At least I want to get something back for all the money I spent on this job this business that didn't work for me. So year 1 loss, year 2 loss, year 3 loss, year 4 loss. The fact that you take a loss every year in a business for a sole proprietor, an LLC, could be a red flag, because the IRS looks at these patterns and the IRS code says you're allowed losses 2 out of 5 years. Why? Because the IRS wants to see that you have a profit motive, some sort of guide, some sort of business plan that you're going to be making money in the future, but they want to see that you have a business incentive to stay in this business. Why would anyone stay in a business that lost money every year? The IRS asked that question, and they came up with this rule: 2 out of 5 years, you have to show a profit. What happens if they call on you? Red flag, you get a letter, and you have to prove to them that, yeah, this really is a business. And they say, no, it's not. they're going to reclassify your business as a hobby. Hobbies, you have to report the income you earn from hobbies, but you only can report the losses up to and including the amount of income. You can't show a loss. You could negate all your income if you have the expenses, but you can't show a loss for a hobby. What's a hobby? A hobby is the artist that, my father, may he rest in peace. He was an artist. He put his paintings up in galleries, in shows, and he would sell a couple. And, oh, great, I made $300. He takes us out to dinner. But his art supply bill was hundreds of dollars, way more than he'll ever get in the sale. You make jewelry on the side. You sell items on the internet for extra money. It's like, yeah, this could be a business. I call it my business. I do this a lot. But the IRS is going to say, if you don't actually have a profit incentive, we can't really call it a business. You could claim the deductions up to the income. So watch out for that. Also, I have a client, he just bought a plane. Joe, you're great. I hope that you can take me on a flight one day, but it would be personal use of the airplane. And you have to watch that the business purpose has to be proven every year. You need, with a charter service, you need 50% or greater business use in order to claim the plane's 100% depreciation deduction. So watch out for personal use. So you have that deduction. That could be a red flag if you can't prove that. So you get the idea. If you're sloppy, if you don't pay attention to the tax law, losses every year, red flag. If you put entertainment on your tax return, red flag. You're gonna raise the suspicion of the IRS. So you got to be careful about that. So what did we talk about today? We talked about two types of audits. We have the field audit and we have the correspondence audit. And you're going to get a letter if you forget to put income on your return. That's not an audit. It's just a letter, CP 2000 letter that says, report the income, please, or pay the tax on the income, please, or give me an amended return. The other correspondence letter is basically asking for more information. Why? Because you have a red flag on your tax return. You put the word entertainment. I had a client on a rental property, no joke, I just saw it a couple of weeks ago. The accountant prepared it, putting homeowner insurance as the title of the deduction. No idea why. Homeowner insurance is not a deduction. It's maybe a deduction on a home office because the insurance is part of that home office deduction, but it's not a rental deduction. So I don't know. Some accountants don't think, they just do. You give them the numbers, they put it on. That's an H&R block, okay? That's the people that do it themselves on TurboTax sometimes. They see a deduction. Oh, I see this. Okay, let's do this. You got to be careful. I definitely am a proponent, of course, right? It's my business to seek out professional help if you don't know, if you're not 100% sure of what you're doing. So we talked about those type of deductions. And business losses, you can't claim them every year, okay? And even the corporations can claim it every year, but can't deduct it every year. You can only deduct in a S corp or a regular corp if you have basis in the business. That means the money you put in is what you can get out as a deduction. But if the business borrows money from a bank, puts the money into the business, and you write checks and take deductions, That's not money you put in. The bank put it in. You may be personally liable for it even. IRS doesn't care. The bank put it in. So you can't claim a loss for those deductions. Yes, you can carry it forward. So we talked about losses. I'll just say one quick thing about $10,000 a year in cash that you can deposit into a bank. You can do it all at once, or you can do it in a series of payments that look like it's all within the same time frame. The bank, if they pick up on that, and they almost certainly will, they report that information to the IRS. 10,000 or more. You could put money into a bank. You can put whatever you want into a bank. 10,000 or more, they report it to the IRS. So wouldn't you think if you do that every month from a cash business like a laundromat, a restaurant, you would think that on the tax return you would have at least $120,000 of income. Well, the IRS makes sure you do because the bank is telling them that you do. So you got to be careful what you report. So those are the things that are red flags. I just glossed over a couple of the big ones, right? The home office, the auto, entertainment, business losses basis. Watch out for your basis. That's a complicated worksheet. Cash transactions. These are all red flags. And you might be scared that you're going to get an audit, but you're not going to jail because you haven't evaded taxes. You just made a mistake. You omitted something. You put something down that you weren't sure of. The number was too big, and the IRS is just asking why. These are just correspondence letters you're getting from the IRS. You have a 1% chance of receiving these letters. It's a bigger chance if you put red flags on your tax return. My name is Mark Binder, and I make filing tax returns less taxing. Thank you for your time today.
Thank you so much, Mark. That was great.
Thank you.
Very good. And, I think comedy could be a second career for you as well.
I appreciate that.
You got it. You got it.
Thank you, Chet. I appreciate that.
We have a bunch of questions for you.
Oh, no.
Yes, we do. So the first question we have is, if you are audited once, does that increase or decrease your chances of being audited in the future? Does it put you into a different pool?
That's a good question. Very good question, because there was a time when I would say, without any uncertainty, it's not true. But we have a client that, well, they have over $10 million in revenues, right? So it's a big client, and they get audited every 3 years. So yeah, if it's worth their while, they will keep auditing you until it's a clean audit. My guess is after the clean audit, they're not coming back. But this one client isn't a clean audit because, well, I can't really say. But if you want to ask me offline, I will tell you.
Okay. The next question is, we were talking about the itemized deductions, and they look at a person's income to see what the average is. Do they also look at what the occupation is for that person? So a person being in a service industry versus a different industry.
Yeah, really great concept there. I'm not sure. I don't know the answer. I would imagine not. Because here's why. Because we have a field on the tax return to put down what your occupation is, but it's an alpha field. It's for letters. Typically, when the IRS is dealing with types of businesses or types of taxpayers, they use the NAICS code. I don't know what that means. National Association of Industries Segment Code or something. I don't know. So it's numeric. You'll see that on a Schedule C for a sole proprietor. They ask for the numeric code for that business. So that would probably go into the calculation of comparing deductions. But on an itemized deduction with you just being a teacher or a sales rep, or I don't think that would be a factor.
Great. And In your 35 years of being an accountant, what do you think is the most overlooked deduction out there?
Overlooked in what way?
People just always forget to include that as a deduction on their tax return.
I
As
had
far
one
as an
tax return that they overlooked depreciation because he thought that was a red flag. He didn't want to take depreciation. That was wrong. It's not a flag. But overlooked deductions, well, in New Jersey, the medical deduction is the most overlooked.
Okay.
Nobody cares about the medical deduction, line 31 on their tax return. If you have a number there, by the way, that means you could have told your accountant or put into TurboTax all your other medical, out-of-pocket medical expenses and taken a tax deduction on New Jersey. Federally, it's pretty much you don't get the deduction because we subtract 7.5% of our income from the medical expenses. Whatever's left over is your deduction. Well, you generally lose that deduction, but on New Jersey, you only subtract 2%. And the health insurance from your employer, okay, if it's pre-tax health insurance plan, it's pre-tax federally, it's not pre-tax to New Jersey. You'll notice your New Jersey wages are higher than your federal wages. So since it's not pre-tax for New Jersey, we're obligated to take a deduction on line 31 for it. Yes, our tax software knows this when you put a W-2 in correctly. It knows that you should get a deduction on line 31. But what people miss is adding to that deduction. And not only is prescriptions, medical bills, hospital stays, therapy, all those are always have been deductions. Last year and forward, over-the-counter medical expenses, over-the-counter, aspirin, Tylenol, I'm at a loss. I don't go too often to get that kind of stuff. Not suntan lotion, right? You're not diapers, but something medical related over the counter. It doesn't have to be prescription. It's deductible now. So I would say that's the most missed deduction.
All right. And then this is a question that I have for you, being that I'm in the service industry and I do meet with clients a lot at their home. Is there a mileage amount that is safe to deduct that might not necessarily be the actual amount? Like, is
So
there
when
a
you
mileage
say-
number that
So
you don't want to go over?
I get it, Todd. I understand what you mean when you say safe. It's the number that is just under the number that's going to hit the red flag.
You got it.
So if you're a salesman, well, first of all, I don't think you're going to bypass the red flag if the number is large. What's large, I don't know. But if they're going to pull your return and look at it, which I don't know that they do or not, and if you're in sales, then your mileage should be $25,000 to $35,000 a year in post-pandemic world, right? Last 2 years, it should be hardly anything.
Okay.
I've seen mileage on tax returns that are basically you travel about 15 to 20,000 miles a year. If you're a commuter, if you're active with your car and that's that sort of thing. And people for businesses that for yourself, if you go out and take clients, go out to dinner, I wouldn't be surprised 25 to 55% business use would be acceptable. They wouldn't even sneeze at it. So,
Okay. And that being said, if there is a number that a client of yours gives you that doesn't seem right to you or you think would trigger an audit, are you going to say something to them?
always, every time. So for the client that gives me rounded numbers, I say, these look made up. I don't mince words. It's like, these look made up. Did you not go use a calculator? Did you not look at your receipts? No, these are estimates. It's about right. Don't worry about it. And that's when I talk to them about the audit lottery.
Okay,
So
great.
amazingly, the numbers come back to me with like numbers at the end, not rounded.
Gotcha. Now, if you have a office in your home and your home has HOA fees, can you deduct a percentage of those HOA fees?
Yes.
Great.
Yeah.
All
they go
right.
off those too.
And then the last question, what would be the deduction in 2023 for business meals? Is that changed at all? Or
Not
entertainment?
aware that they extended it.
So there is no deduction anymore?
No, it goes back down to 50%.
50%.
Yes.
All right. All right. And then the last I'm going to add to this, because that's the last of the questions. I too have a IRS joke for you.
Okay, great.
And it is, why doesn't the IRS audit cows?
Oh, no. I don't know.
Because the farmer milked them dry.
Oh, yes.
There you go.
That's great. Thanks, Todd.
You got it.
Thanks,
You
Bob,
got it.
Brandon, Jacqueline. Appreciate the opportunity.
All right. Bob, Brandon, anyone, anything to add? Jacqueline? All right, Mark, thank you so much for this. This was great. It
Okay.
was entertaining as well, which makes it easier to digest as always. And we look forward to seeing everyone next quarter for our next webinar.
See you next year.
Thank
Nice
you for
hat,
joining.
Bobby. Nice hat.
Bye-bye.
Nice hat, Bobby.
Take care.